Okay, so for this video, I wanted to cover the Schedule C that is included in some circumstances with a Form 1065 partnership tax return. So Schedule C, this is not to be confused with the Schedule C that you might see on a Form 1040, right? Schedule C is used to report profit or loss from a trade or business by an individual taxpayer. This is different, right? Form 1065 has its own Schedule C, and that's what we're looking at right here. So I have this in front of us as an example, and then I have a slide here with some of the rules around when you need to include this Schedule C, and then we have a fact pattern that we'll go through that will require us to answer yes to one of the questions that we'll see on the Schedule C attachment. So Schedule C must be included with a 1065 if the partnership also needs an M3. So an M3 is a net income or loss rec for certain partnerships. It's basically an expanded version of the M1. And so if you need an M3 because you're a large partnership and you meet additional thresholds, then you'll need a Schedule C as well. Okay, so M3s are generally included if a partnership has more than 10 million in assets or 35 million in gross receipts for the year. But also many 1065 filers will include an M3 voluntarily because it provides more detail on the book to tax adjustments for a partnership, as well as more detail on any pass-through interests it might have. And so for that reason, a lot of companies and preparers prefer to use the M3 rather than the M1 just because it provides some more detail for the reader. But yeah, again, you can include it voluntarily, and a Schedule C can be included voluntarily as well if needed. So let's look at an example of a Schedule C filing requirement. We have fake partnership LP here. It's a Delaware limited partnership, taxed as a partnership for federal income tax purposes, so it's going to file a 1065. As of 2020, at the end of the year, the LP had total assets of $65 million. So the partnership is required to include a Schedule M3 because it has more than 10 million assets. Right now, the Schedule C is included if the partnership has more than 50 million in assets. So in this case, they need both. They need the M3 and the Schedule C. Now, if you're a partnership that's between 10 million and 50 million in assets, you likely don't need the Schedule C, but you might want to include it anyway just voluntarily, right? You're free to do that. Okay, so moving on with the fact pattern here, we have the limited partnership holds a 5% capital interest in Investors Group ABC LP, a Wyoming limited partnership, which it acquired in 2018. Okay, the Investors Group is owned by 5% by Fake Partnership LP, and then 95% of Investors Group is owned by a third party, Jane Doe taxpayer. Now, under the terms of the LP agreement in Investors Group, the fake partnership, right, our guy up here, our partnership, is the manager of the Investors Group portfolio, so it's being allocated a performance fee for each year for managing the assets. The performance fee is 20% of the Investor Group limited partnership's net profits. And then after that allocation occurs, the remaining profits are split in accordance with the capital ownership percentages, right? So a 5-95 split. So if the Investors Group generated $2 million in profits for 2020, our company, Fake Partnership LP rather, is allocated a performance fee of $400,000, so 20% of $2 million. And then after that allocation occurs, it gets 5% or $80,000 of the remainder. Right, so for a total income allocation of $480,000 of the $2 million. Now the remaining $1.52 million is going to be allocated to Jane Doe taxpayer, right? That's her share, that's her 95% share of whatever is left. Now you'll see here that the total income allocated to Fake Partnership LP of $480,000 far exceeds their 5% capital interest in Investors Group, right? I mean, if they only had 5% and there was no performance fee, then $2 million in profits, they would only get $100,000, but they're getting $480,000. And the reason for the disproportionate allocation is the performance fee. Now, why do I highlight that? Because that is a question on the Schedule C. So if we go back to Schedule C, we look at, there's only 6 questions, right? Not too much detail here. But one of the questions, if we look at number 2, it asks, does any amount reported on the M3 part 2, lines 7 or 8. So 7 or 8 is allocations of income from a partnership. So does any amount reported on these lines reflect allocations to this partnership from another partnership of income, gain, loss, deduction, or credit that is disproportionate to this partnership's share of capital, or its ratio for sharing other items of that partnership? In this case, we would answer yes, right? Because we are receiving an allocation that is disproportionate to our investment in that underlying partnership. That is what happens when you have a performance fee allocation, okay? And so we're answering yes. All the other questions are answering no because they don't apply to us. But what you do see frequently is a change in accounting principles. There'll be those disclosures down here, right? That does come up relatively frequently. And then question number 1 as well, oftentimes there are contributions by the partners to the partnership or vice versa. And for that reason, there might be a disclosure requirement under this Treasury reg. But in practice, I think the most common one I see when this disclosure is required is line item 2. So question 2, and then probably lines 5 and 6 as well, right? So a change in method for tax purposes. Okay, so that covers it for this video. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.